Hi, welcome to our next episode of Coffee with Alissa. This quarter, we're going to be focusing on different aspects of real estate investing. Today, I'll be interviewing Tyler Reeder, the director in the Schneider Downs Corporate Finance Group. And Tyler's primarily responsible for supporting transaction execution and business development for the Schneider Downs Corporate Finance real estate investment banking practice. He focuses on raising equity for stabilized assets and projects under development across a variety of asset classes. Among his other responsibilities are coordinating property due diligence, financial modeling, and market research. So obviously, Tyler has some vast experience, so I asked him to join us today to bring his expertise of the industry to provide us an update on commercial real estate and the ins and outs of investing in it. So thanks for joining us today, Tyler. How are you doing?
Hey, now, Alyssa, thanks so much. Great to be here with you, doing well, and looking forward to talking all things real estate here.
Well, to start out, why don't you tell us what Schneider Downs Corporate Finance is and what you do?
Similar to Schneider Downs Wealth Management, we are an affiliate of the broader Schneider Downs accounting firm. And so we have within our group, it's a real estate investment platform where we work, alongside experienced developers and owners of commercial real estate. And then we, will help provide capital for them to develop and build or develop or buy, properties throughout the U.S. We generally focus on multifamily apartments as kind of our core, the asset class that we focus on mostly. But we historically, have invested in some student housing properties as well. So we generally connect investors with real estate investment opportunities as kind of the core of what we do.
So to kind of dive into real estate investing, what are some of the risks and benefits of doing so, and what makes a good deal?
Yeah, look, real estate, like any investment, there's risk with it. I would say one of the biggest and most important to consider is it's generally an illiquid investment, right? Meaning it takes time to sell a property, and there's ultimately how much time it can take, and then what price you can ultimately buy it for. You compare that to a stock, for example, can be sold more frequently, and is more easily accessible. So real estate tends to be a longer term investment that you look at maybe over a 3, 5, 7 year time period from an ownership perspective. Another risk with real estate is just changes in the way we use it, right? Office space, I think, is probably one of the best examples of this. As over the last couple of years, the way Americans work and where they work, certainly has changed, and the need for office space changes. So those types of things, certainly impact real estate values and how good it ultimately is from an investment perspective. I think maybe the third key risk and consideration is the use of debt in real estate, right? It's an asset that you can, just like your home, you can borrow against it. And, the reasonable use of debt, I think is certainly a risk that we always, pay attention to. Look at the benefits, right? Real estate it's a real tangible asset. You can see it, it's not just a financial instrument, if you will. And it tends to be a little more stable and doesn't have some of the volatility that you would see in other financial investments. And makes it a good diversification tool, inside of an investment portfolio. I think the other, big component or benefit of real estate is it is generally, treated pretty favorably by the tax code in the U.S. And this can vary depending the way that you own real estate, but certainly as a generality, owning real estate tends to be pretty favorable from a tax perspective.
What about cash flow appreciation wise? Can you speak a little bit about that?
Yeah, and that's, I think there's sort of, if you think about how do you generally make money in a real estate investment, you've got, in a lot of cases, sort of two components to that, right? One, as you own it, maybe on a quarterly, monthly basis, you get excess cash flow distributions from the investment that make up a part of your return. And then ultimately, when you sell it after a 3, 5, 10 year period, whatever it might be, the expectation of some value appreciation along the way. And the combination of those two certainly make it more powerful, from an investment perspective, the ability to generate and compound capital over time.
So what are some different ways that the average investor can invest in real estate?
Yeah, I mean, the first one, and one we see often is a real hands-on approach, right? An individual, owns a single-family home in a neighborhood close by, or a couple apartment units in the city that they live in, manage them themselves. They handle the maintenance, they find tenants. Very direct, very hands-on, but also very time-consuming way. And depending on folks, other career or family obligations can make that challenging. So there's also numerous ways and more of a hands-off, passive approach to it. Owning a stock in a REIT, it's a real estate investment trust. Those are typically publicly traded. Just like any stock or security, you can buy them and sell them relatively quickly. One way to get ownership or get exposure to real estate, and then others are more direct. If you think of being a limited partner, where you are as a limited partner, you're providing investment capital along with generally an experienced owner or developer to go purchase a single property, maybe a small portfolio of properties. That certainly comes with tax benefits as a direct owner, but limits the limited partner's involvement. It's more of just a pure financial investment. At that point, you're not getting the maintenance calls in the middle of the night from a tenant when something's not working at the property. Nice benefit to that is the investor generally has some discretion over the type of property that gets invested in. You can sort of pick and choose where the money gets invested. Another common form that we see that is direct but still passive is more of a discretionary fund, right? Where you, as an investor, commit X amount of money to the fund, and there is a manager of that fund that will go, allocate your funds and other funds, according to a predetermined strategy, but they pick and choose the markets and the assets that you're ultimately invested in. So, less work on part of the investor. You're sort of making one decision, but certainly requires some more vetting and understanding of who's managing that and who's making the decisions on your behalf. So all different ways, all sort of have different, risks and benefits to them, and certainly, kind of tailor to more to what's the investor ultimately looking for, how involved or uninvolved, they ultimately want to be in picking properties and decisions and the like.
Yeah, and I think something I learned about recently, the traditional real estate deal, right, has only been open to accredited investors, right, which are people of higher net worth. And of course, I'm sure you're getting a higher level of service and due diligence, but learned about recently crowdfunding opportunities for non-accredited investors. Could you tell us a little bit about that?
The digitization of our entire society has really, taken over. That's blended into real estate, right? So, we have seen, various online platforms, provide the opportunity to invest in real estate, to a more broad audience. It tended to be more of a insular type, tight-knit group or community, if you will, before, but certainly these online platforms, have opened that up. And I think, with greater access to it, certainly comes, more responsibility for the investor, certainly to understand who they're working with, who they're partnering with, and, the overall structure that's being offered to them. So certainly provides greater access to investors than we've seen in the past.
I think a big hot topic over the last few years with COVID and the current economic climate, we've seen real estate of all types just kind of hit some major inflation. Both, the value of the real estate, also the cost of rent. Can you talk a little bit about this COVID era of time, the changing trends with real estate and the economic development that you've seen come about?
Yeah, look, I mean, the pandemic has changed and touched all aspects of our lives. Real estate certainly, is included in that. I think one of the biggest shifts that we've seen from the pandemic, I hit on it a little bit earlier, as it relates to office space, right? It shifts where we work, how we work, the amount of space that a company needs in an office building, may ultimately change. The way they use that space may ultimately change. And that, the occupancy of a building and the amount that the tenants pay for it ultimately drives the value of that building, right? Less occupants, lower rent, lower overall value. Vice versa, is the same. So you certainly that's still playing out, and I think will play out, for a number of years. Retail, is another part of real estate that has certainly seen a lot of transition, throughout the pandemic, right? Whether it's further shift to online shopping, picking up groceries at curbside pickup at any restaurants or any retail outlets, as well as we've seen many big box retailers, Target, Walmart, using their vast retail real estate footprint to use those sites as distribution centers. Meaning, if a product is in stock at your local Target, that'll get shipped from the store to you much closer rather than a warehouse halfway across the country. So it's changed that. I think those two areas of real estate, probably the most of any. The economic climate you hit on that certainly as well. I'll narrow that to multifamily apartments, certainly, since that's our expertise and our focus. I mean, I would say late 2021 into 2022, we just saw record levels of rent growth in almost all markets throughout the country. In certain cases, well over 10% on an annual basis, which you compare that to a historical average, it's more in the 2 to 3% range. So just a really outsized growth in rent. And likewise, occupancy at property. Properties were also hit from a multifamily perspective at a historically high level, and just a lot of changes to migration patterns, right? Where people live, where they have to live for their jobs, and we've just seen all sorts of shifts and movements, throughout the country of where people live, and that ultimately impacts the demand for housing in those areas. And we also work on development opportunities where we build apartment communities throughout the country. That certainly has been impacted by this as well, right? While rents increasing at the levels that they did certainly increases property values from an investment perspective. With that also comes, much higher cost for labor, materials, and makes developing properties, significantly more expensive than it was 2 or 3 years ago, which also creates its own challenges. And finally, certainly, and in a lot of folks' mind right now is the recent quick rise in interest rates that we've seen. A leveraged asset like real estate, certainly is subject to that, and is one of the major risks, that I mentioned earlier. That the prudent use of debt, is a key determinant in the ultimate success of a real estate investment. So lots going on recently, and it's sort of an ever-changing. The world is changing quickly around us, and that certainly all comes in from an investment perspective as well.
Just to finish up here, if people are thinking of investing in a deal, whether it's a really structured deal or one of those crowdfunding deals, can you give us some, just key points or facts to consider before doing so?
Yeah, I would say first and foremost, who you're investing with, right? The owner or the developer, what's their level of experience, both developing that type of property in the market that they're in, their overall experience and the experience of the employees at that group, and just their track record really, generally makes a big difference. And I would, who's investing alongside you, right? Whether it's the sponsor, or the developer of a property, are they investing their own money, or an advisor or friend that's bringing you an opportunity? Are they also investing in the transaction? That tends to show a great level of alignment of interest, and is also a good sort of thing to pay attention to. And, finally, like any investment, there's fees and costs associated with it. And some real estate investments, have higher levels of fees and costs, some less. And so, that can certainly have a big impact on the overall performance of an investment and the overall returns that you get. So I would generally say from a fees and cost perspective, certainly fees that are geared more towards performance and performance-based profit sharing structures tend to be best, because it aligns the fees are greater in cases where the overall performance of the investment has done better as well. So I think those are three things that we look at a lot, and I think certainly can help frame what's a good opportunity.
Tyler, this has been incredibly informative. I appreciate you sharing your time and your expertise with us, and I hope to see you soon.
Yeah, thanks so much, Alissa.